Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner practitioner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. Really appreciate your time and your attention today. And on to this episode, we're going to dive into the question of how much should you pay yourself from your practice? And this is a very common question I get, especially from early stage practice owners, so recently cold started or recently purchased within the last 5 years or so. A common question is, how much should we pay ourselves? How much income should we take from the practice? When should that change? But that isn't a question only for early stage practice owners. This is a question that we need to think through with established practice owners and keeping an eye on how much income they're drawing from the practice and how much they're paying themselves in wages and when to make those adjustments. And so into this episode, I want to talk about 7 key factors or 7 key considerations to balance as you think about how much to pay yourself from your practice, specifically in terms of a wage. And this is for practices that are taxed as an S-corporation. Most of what we'll talk about today are going to pertain to those practices that are taxed as S-corporations because you have that requirement to pay a wage. And so you have to decide how much of your income should you take and how much of that income should be an actual wage. But I think regardless of how your practice entity is taxed, I think you'll learn something about these decisions today. And this conversation today is going to be an extension or a continuation of my article with Independent Strong. And that article was how to pay yourself, key factors for setting your owner compensation. So I'll throw a link to that in the show notes. Recommend reading that and some of the other articles we've done there. But I think the first place that I think that makes sense to start is just talking through how you as the owner take income from your practice depending on the different type of entity you have, or really depending on how your entity is taxed. The first one is if you own a sole proprietorship, meaning there is no actual legal entity separate from yourself, it's just you doing business as something, or if you have an LLC and that LLC is taxed as a sole proprietorship. There's only one owner, and this is the default ways that LLCs are going to be taxed if there's one owner, unless you've chosen to do something else. So if you have this type of practice entity, how do you pull income from the practice? Well, it really is just an owner's draw. You're just taking dollars from the practice bank account and transferring it to your personal household bank account, or you're writing a check to yourself. It really is as simple as that. I mean, that's essentially how that looks. If you are a partnership, or if you have an LLC that is taxed as a partnership, there's 2 or more owners, and it's taxed as a partnership, it can come in 2 forms. Number one, it can look like a profit distribution. So that's going to look very much like it would look in a sole proprietorship. You're moving dollars from your practice bank account over to your personal one. Or it could show up as guaranteed payments. If you pull up the profit and loss, you might see guaranteed payments in there for each partner. And this is a form of a wage, like this is the partnership's version, something similar to what you'd see as a wage. Basically, it allows the partnership to send dollars to an owner regardless of what the actual profit of the business is. So if different partners are working in different schedules or different amounts of production, this might be a way to sort of distribute income among different partners depending on the production. Now, if you see that on your profit and loss, if you see that your practice is creating guaranteed payments as part of that income, I would talk to your tax professional and ask about how that impacts the QBI deduction and whether you can distribute income in different ways that are not so heavily leaning on guaranteed payments, because only the actual profit of the partnership is eligible for that QBI deduction. The guaranteed payments are not. So something you'll just want to look into, and your partnership agreement or your operating agreement is going to be the rules around that. So that's something you'll want to keep an eye on and review as well. But that's what a partnership looks like. It's either going to be profit distributions to the partners, or it's going to show up as guaranteed payments on the profit and loss. Either way, it's going to be moving dollars from the bank account of the practice to the bank account of the owner. So S-corporation is different. If you've listened to my episode on how these different entities work, I'll throw a link to that in the show notes, but an S corporation is a tax election. It's a way that your business chooses to be taxed. The legal entity isn't an S corporation. The legal entity is either going to be an LLC, it's going to be a corporation in certain states, and in some states I've seen a PA as well. But the legal entity is one thing, and then your legal entity, the LLC, the corporation, can elect to be taxed as an S corporation. And so the S corporation is a tax election. And the way that you draw income from an S corporation is you take a wage, a required wage, and then you can distribute to yourself profit distributions, similar to the other forms. You can send dollars from the practice bank account over to your personal bank account. And so your wages, you're going to be on a payroll just like everyone else in your practice. And then you can take owner's draws, owner's distributions in addition to that. And the S corporation is especially interesting. And most of our conversation today is going to be in light of those practices that are taxed as S corporations. How much should you pay yourself in wage? How high should that be? How low should that be? When should that be increased? And how much should you take as owner's distributions? And when you think about the benefit of choosing to be taxed as an S corporation, the primary benefit from a tax perspective is saving employment taxes, because when you are taxed as a sole proprietor, all of your net income from self-employment is subject to self-employment taxes. So both halves of Social Security and both halves of Medicare. However, when you are taxed as an S corporation, only the wage portion of your income is subject to employment taxes, Social Security and Medicare, but the profit of the business is not. And so whatever the profit is, you save roughly 15.3% of those employment taxes on that profit. That's part of the benefit. And so very often we are thinking about the wages of trying to bring that wage as low as possible. And in some conversations I've had over the years, we've seen wages unreasonably low. I mean, sometimes around like $30,000 specifically to save taxes. But as we'll go through this conversation, that can't be the case. And what I want to talk through today is what are the different considerations you need to think through to figure out how much your wage should be relative to those profit distributions. There is that heavy incentive to bring it down, but as we'll see, there are also situations where you want to increase your wage. There are other planning opportunities where we're going to want to increase that wage a little bit more. And so let's talk about 7 key considerations you want to keep in mind for figuring out how much wage to pay yourself in the practice when your practice is taxed as an S corporation. The first one to think through, number 1, is cash flow sustainability. Your practice has to be bringing in enough gross revenue, collected revenue, in order to pay for inventory, cost of goods sold, in order to pay for all the other operating expenses, occupancy costs, non-OD staff, OD staff compensation if you have associate doctors. Go through the list of operating expenses. Your practice has to be creating enough cash flow after those primary expenses to pay yourself a wage. So the first thing that has to be looked at is, what is the cash flow of the business? This is more so important with a cold start, because in a cold start, it may take 2 to 3 years before you really start to see enough cash flow to provide for yourself a healthy wage. So you really want to keep an eye on the cash flow sustainability of taking a wage and not taking too much too quickly. But even in situations where owners have purchased practices, it may make sense to keep that wage than we might otherwise set it. But those owners are often wondering, when does it make sense to increase it, right? So the first thing we just need to keep an eye on is, what does the cash flow of the practice look like? What can the cash flow support? Number 2 is the IRS reasonable wage requirements. When you own a business that's taxed as an S corporation, the IRS has a requirement. You have a requirement to pay yourself, the owner, a reasonable wage, quote unquote reasonable. Before you start taking profit distributions, the first thing that has to be met is you have a reasonable wage that is compliant to yourself. And what is reasonable, quote unquote reasonable? Well, there is no specific black and white rule or formula to figure out what is reasonable. You'll see a lot of stuff out there about like rules of thumb, make sure that it's 50% of your profit or something like that. Well, there's nothing really supporting that. But when you look at the IRS website, and I'll add this to the show notes, you're going to see that they provide a list of factors. Some factors they consider to determine like a reasonable compensation are training and experience, your duties and responsibilities. So what are you actually doing in the practice? Are you only seeing patients? Do you have management or administrative responsibilities? How often are you seeing patients? How much time are you actually spending in the clinic seeing patients each week? Your time and effort devoted to the business, your dividend history, so your history of distributions, payments to non-shareholder employees, timing and manner of paying bonuses to key people, what comparable businesses pay for similar services, compensation agreements, the use of a formula to determine compensation. When you kind of boil it down, it really comes down to what would you pay someone else to do the work that you are doing in the business as an employee. And I've seen some consultants and tax professionals really actually like formulate it down, like how much of your time are you spending seeing patients as a clinician? How much of your time are you doing administrative duties? And what would the wage be for each of those broken down? So really that's the way you'd want to look at it, is what is a reasonable wage for the work that you are doing based on your experience in the practice. And ultimately, you would want to just talk to your tax professional to make sure it's compliant. There is no perfect amount. It's all a range, right? So you have to figure out what that reasonable range is for your area of the United States. And I would lean entirely on your tax professional to make sure that that's compliant. So number 2 is that reasonable wage requirement by the IRS. And for those of you who are paying yourself $30,000, $40,000, that's, unless you're working less than part-time, that's not reasonable. So you want to make sure you're not going to be falling into trouble with the IRS. Number 3, employment taxes and compensation. And this is the primary tax benefit of choosing to be taxed as an S corporation, is that only your wages are subject to employment taxes. The profit is not. And hence this incentive to keep your wages on the lower end of that reasonable range. In 2025, wages up to $176,100 are subject to Social Security tax of 12.4%. So that's both halves of it, the employer and the employee. You are both. Any wages above that are not subject to Social Security taxes. But all of your wages face Medicare taxes, and that's a total of 2.9%. Again, half paid by you as the employee, half as the business owner. So you do have to keep in mind the potential tax savings by maintaining a reasonable but potentially relatively low wage as a part of your tax planning. I would also look at things like fringe benefits, for example, health insurance paid through the practice, HSA contributions, dental insurance paid through the practice. Those fringe benefits paid through your practice or through your payroll as the owner have to be added back to your pay stub as a wage for income taxes. So you're going to see that added back as income on your pay stubs. However, those fringe benefits aren't subject to these employment taxes. So that's sort of a sneaky way to increase your wage to something that is reasonable without increasing the amount of Social Security and Medicare taxes you're going to be paying. So tax planning around employment taxes is definitely something you need to keep in mind and work closely with your advisors on. But the other side of that that's really important is your Social Security benefit in the future. Because if you are lowering your wages below that Social Security wage base, that $176,000, if you're lowering your wage below that, that means you are missing out on credited wages towards your Social Security benefit in the future. And so we kind of have to balance that out. We have to consider that. However, when we also have to think about the way that Social Security calculates your benefit at full retirement age, which right now is age 67 for most of the people listening. When you think about how Social Security calculates your benefit, again, at your full retirement age, what they're going to do is they're going to look at your past earnings at the highest subset of your past earnings history, specifically your wages or income that were subject to Social Security taxes. And they're going to adjust past years of wages or earnings for inflation up to age 60. So they're going to sort of equalize them for inflation. And then they're going to look at your average monthly wages based on all these years of earnings history. And then when they calculate your benefit, they're going to replace a certain percentage of that average wage, but in tiers. So for example, they're going to replace 90% in 2025's dollars. They're going to replace 90% of the first $1,226 of monthly wage. For the next chunk of your monthly wage, up to about $7,300, they're only going to replace 32% of those dollars. And then for the last bits of your monthly wage, over and above roughly $7,300 a month, they're only going to replace 15%. So there's a sort of tiered percentage of your monthly wage that's going to be replaced as part of your benefit. As we know, Social Security is built to help lower earning retirees more. And so we see this in the formula in $2025. Once your annual wage gets to about $103,400, between that and $170,000 or so, your benefit's only going to replace about 15% of your income. So hopefully that's not clear as mud. But the reason I point that out is because once you get to that point, you're really getting back a small percentage of your income and Social Security benefit. So if you have a healthy savings rate, which is really important, and a consistent habit of saving, then you may benefit from keeping your wage below that Social Security wage limit, about $176,000 or so, and just investing the extra wages yourself. Your return on those dollars may be higher. Of course, that's not guaranteed, but it may very well be higher than just the 15% you're going to get back on that Social Security benefit for those extra wages in that 15% tier. Now, that only works if you have a healthy savings rate and a consistent habit throughout your career of investing those wages. However, too often, and I've seen this many times, too often, there just isn't enough saved for retirement over the career of the owner. And the owner may have been better off increasing wages and just getting a higher Social Security benefit. You have to know yourself a little bit. Can you be disciplined about taking those extra dollars and investing it rather than just spending it and let it go to waste? So there's two sides to that coin. Yes, you want to save taxes on Social Security taxes and Medicare taxes, but you also want to optimize your wages for that Social Security benefit as well. Number 4, the QBI deduction. And this is what I had talked about earlier with guaranteed payments and partnerships. With an S corporation, the QBI deduction, that 20% deduction that is currently happening through 2025, and we expect that through legislation to be extended into 2026, although we don't know for sure, only the profit of your business is eligible for that deduction. The wage portion of that is not. So the higher your wages, the lower your profit. That means the lower that deduction is going to be. The lower your wages, the higher your profit, the higher that deduction's potentially going to be. Of course, it all depends on the math of the situation there. But so that deduction is something you want to keep in mind as well, of figuring out, okay, what is the optimal wage to have based on the planning opportunity with that QBI deduction. Number 5, personal financial stability. Above all else, your practice should be providing for your ideal lifestyle. I would consider that the primary and main reason you own the business, that you go to work every day, is so that business can provide for your ideal lifestyle, which includes saving and investing for the future and for different goals like college savings and different things like that. But it should support your ideal lifestyle spending. What do you want to spend dollars on? What are home updates you want to plan for? Who are the people or institution, organizations you want to give money to on a regular basis? So you want to make sure that your practice is supporting it. And there's no simpler way to create a consistent, predictable income from a business than setting your wage at or around that ideal lifestyle. So, and this requires, of course, you understanding the numbers, understanding what you actually want your ideal lifestyle to look like in dollars. What do you want to spend ideally? Who do you want to gift to ideally? What are some of the other goals you want to set aside dollars for each and every month? What are the debts that you're paying on a month-to-month basis? And so having clarity around what that ideal lifestyle is going to be should then inform your wage as well, so that you can set a wage that can give you predictable, consistent income to meet that lifestyle. Number 6, retirement plan maximization. This is one of the important factors that are going to nudge you to increase your wage, because your W-2 wage is directly going to determine your retirement plan contribution limit. So for example, if you're making salary deferrals as an employee, whether it's to 401k or simple IRA, you have to have enough wage in order to do that and to cover payroll and to cover your lifestyle expenses. So your salary has to be high enough to meet your retirement plan savings goal. But importantly, 401k profit sharing contributions are directly impacted by the wages paid in your practice and by the wages you pay yourself. 401k profit sharing contributions are limited as a whole to 25% of W-2 wages in your practice. And your age and the wage that you pay yourself can directly impact that amount of the contribution from when you're doing profit sharing that skews towards your accounts versus all other employees, depending on the calculation, the method of your profit sharing. If you're doing new comparability, for example, that's going to be very important. And so sometimes just to increase that profit sharing contribution to where it needs to be, sometimes increasing that wage helps quite a bit and allows more of that contribution to skew towards your account versus all other employees. This is something we saw with tax projections over the last year. As we got towards the end of the year, we saw that there's opportunities where clients are phasing out of certain deductions like the QBI deduction or the child tax credit, and large, healthy profit sharing contributions allowed them to phase back in, and increasing their wage at the end of the year, before the end of the year, allowed them to really benefit, even when you account for the additional Social Security taxes. So that's something you want to keep in mind as well. And cash balance plan, if you have an established practice, if you're older and you have really healthy cash flow in the practice, maybe you have a cash balance plan or are considering it, that's going to be directly impacted by your age and your compensation history. So for owners focusing on retirement accumulation, of getting the most out of these retirement plans, there's a temptation to lower your wage as much as possible for those tax savings, but it's going to directly impact this. This is something you have to balance with those tax savings. Number 7, practice valuation and accurate accounting of profit. And I say this because your wage should reflect the true replacement cost of your clinical and management work, because someone needs to do the work, whether it's you seeing patients or whether you hire someone else, whether you bring in an associate doctor. Your wage, the cost of you doing that work, is a true expense to your business. When you have artificially low compensation for yourself, this could inflate practice profitability. If you are looking at your P&L each month or each year, each quarter, and whatever cadence you're looking at that, and you're looking at how profitable your business is, if your wage is too low, that profitability is too high. It doesn't reflect the accurate profitability of the practice. It's going to skew your own benchmarking, and it can skew your decision-making. So just for benchmarking and KPI perspectives, I like to make sure there's a market-based wage for the work that you're doing. And if you're doing valuations, then any valuation that's happening for your practice needs to account for market-based compensation happening for the work you're doing. So adjustments would have to be happening as a part of that valuation process. So just for clean accounting and accurate KPIs and decision-making on your part, I like to see there to be a market-based wage in the practice. And so that's number 7. Again, when we think about these factors, number 1, cash flow sustainability. Number 2, the IRS reasonable wage requirements. Number 3, employment taxes for tax planning purposes. Number 4, planning around that QBI deduction. Number 5, your own personal financial stability. Number 6, retirement plan maximization is something that's going to nudge you to increase that wage. Number 7, practice valuation, just accurate accounting of the profit of your practice. Those are 7 key considerations I'd think about as you talk with your financial professionals, your financial advisors, your tax advisors. Those are different things you're going to want to balance. And don't allow one to override all of the others entirely. You want to think about all these things sort of holistically, depending on your goals, right? What are you planning for? What are the opportunities that you're seeing as you are wanting to increase your savings rate, as you're going through tax projections and wanting to make good tax planning decisions? What are the opportunities available to you? And you're looking at your own cash flow. What are the opportunities available to you? One thing that just popped in my mind as well and related to the wage related to employment taxes and compensation. And there are also state and local benefits, for example, state disability insurance or paid family leave that are dependent on the wage you're paying yourself as well. So, look at your state and local benefits that you are maybe missing out on or not taking fully advantage of if your wage is unreasonably low. So keep that in mind as well. But hopefully this is helpful. Again, if your practice is taxed differently, for example, a partnership, some of these things you'll want to think about, like guaranteed payments in relation to the QBI deduction and what your operating or partnership agreement allows you to do, says you have to do there. But things like the profit and loss, for example, if you're not taxed as an S-corp, the profit and loss is going to look different. Like your owner distributions, if you're taxed as a sole proprietorship, well, that's not going to show up on your P&L as wages, right? You have to account for that separately when looking at your business and looking at the real true profitability of your business. So it's going to look, some of these things are going to look differently depending on the way your business is taxed. But a lot of these are primarily going to be around the S corporation. What does it look like if your practice is an S corporation? And so as you set your wage, hopefully this is helpful. As you think about what are the different considerations doing that, what should you be thinking about and balancing as you are wondering if you should be increasing that or if your wage is too low relative to the profit. And then the other consideration is how much and when should you take distributions from the practice? And that's even another discussion of when you should be able to take distributions from the practice and do other things with that cash, because you don't want to leave too much cash in the practice. You want to leave just enough cash to provide a healthy cash buffer, a reasonable cash buffer for the practice, to know that your debt payments can be made. You want to know you're setting aside enough dollars for quarterly tax payments if you're making quarterly tax payments. And then finally, once you've kind of taken care of those things, then you have a clear idea of how much cash is available for distribution. So that's another discussion that relies heavily on what the cash flow of the business looks like. But as you're thinking about your own compensation, as you're thinking about your own life circumstances, like practice revenue growth or increased profitability or additions of a partner to the practice or major personal finance changes, like you want to buy a home or planning for college for kids, if you're implementing a new retirement plan of the practice, if you're expanding the business, if there's changes in laws like tax laws are all in flux right now, all of those things are good opportunities for you to review this and see if changes need to be made. So talk with your financial advisor, talk with your tax professional. If you don't have one, if you are looking for someone to look at these numbers with you, to make good decisions around all these different, sometimes competing goals and priorities, reach out. We'd love to have that conversation with you. We'd love to hear the financial questions on your mind and talk about how we help optometrists solve those and navigate those decisions all over the country. Check out the show notes. I'll throw a link in there if you'd like to schedule a short introductory call. And appreciate your time. We'll catch you on the next episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.